The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So the market on Wednesday was manic depressive. Mr. Market had real problems trying to figure out which medication he should be taking. And one of those areas that attracts a lot of attention, particularly since we've been dealing with inflation for a few years, are precious metals, and more specifically gold. And you can debate whether gold or silver is the right place to be, and that depends upon the time. But right now, gold has been a favored selection by many investors preparing for either more inflation or massive debt increase and the collapse of the dollar. You can choose which one of those arguments you want to have.
Yeah.
But one of the things that has been on the table has been, what on earth is the Fed going to do? We need to know what the Fed's going to do with interest rates in order to decide the direction of gold. And so unfortunately, if you watched our prior podcast, what we ended up with is there was no real discerning conclusion to the day in the market, and it's really no different for what happened to gold on Wednesday. So theoretically, financial theory, falling interest rates make gold more competitive because it doesn't pay a dividend. There's no current economic benefit to holding gold. It is a long-term position. It's a bet on what I can sell it for in the future. It's a conversion to some sort of currency at a later date. There's my return. And it competes with high interest. It does not compete well with high interest rates. When interest rates are high and people can get 5, 6, or 7, 8, back in the 80s, they were getting 12, 14, 15, 18%. For savings accounts, why own gold unless you think the monetary collapse coming? But what happened on Thursday is just like everything else. It had an immediate reaction when Mr. Powell spoke. And then it continued to have hope until it did not any longer.
It did not. And it's so funny. Gold, anyway, it's funny to me. Gold is one of those assets that people, for some reason, people really feel like they can anticipate what gold's going to do. We know when gold's going to go up. We know when gold's going to go down. And it's just not true. Gold is an asset just like any other asset out there. It's a precious metal in the precious metal sector, and it more and more these days it becomes more and more correlated to the market, and it's supposed to be, a hedge against the stock market. If stocks are doing bad, gold should be doing well. That's kind of broken down over the last couple of years. So there's really gold. It's important to understand gold is just another asset class. It's just another asset that you can buy, and you really need to buy it for that reason. No one knows where gold is going, and there's no crystal ball that we've seen that's going to tell you in advance. Now is the time to own gold. And we think it's fine. We've had gold in our portfolio. We've had silver in our portfolios. It's just a matter of when, and that's driven by the price and the price change, not by any narrative about what we think is going to happen with the price of gold.
Yeah, it's also not driven by your personal evaluation of your risk tolerance. Your risk tolerance and your personal evaluation of your own psyche does not affect market at all. Market risk is there every day. And it's not something that can be avoided. You can reduce volatility in your account by not investing in it. I mean, if you don't invest in the market, you'll reduce volatility, assuming you put your money in a savings or something of that sort. There's basically an overabundance of news, analysts, charts, some of which we share with you from time to time. Opinions, they're plentiful. You probably have one yourself. We have them. But what drives our portfolios is process. We have a set of rules. we make the decisions based on the rules, not on Fox Business or CNN Business early morning pre-market open.
Correct.
Everybody's got an opinion, and I listen to them. I do listen to them. It keeps me occupied with not feeling like I'm isolated in my office
Sure.
while I'm doing other work. I don't pay a lot of attention to it. I guess I could use something else for background noise, but I use I use the TV over here on the other side of the room on low. But here we are with gold, and the assumption should be that falling interest rates mean higher gold prices. But then maybe it's higher inflation. But if higher inflation, you get rid of that by stopping economic activity. You've got to slow things down because right now it's a demand problem. Too much demand, not enough supply, and
Sure.
prices rise. If you want to slow the economy and make people quit spending money, you raise interest rates so that businesses lay people off. They go from employment to unemployment benefits and they quit spending money. And supply catches up with demand. Prices fall in the meantime. This is just backwards from what you would expect based on what people did expect, what the market did expect with regard to gold. But that leads to interesting discussion with regard to gold because, as you said, Perry, almost everybody has an opinion on gold,
Right.
how they're going to use it, and what they're going to do with it. And we have clients who are committed gold bugs. I mean, they're
True.
bullish on
Yep.
gold all the time. It doesn't care what we say or talk to them about. And some of them are heavily, overly concentrated in gold. And it's a personal belief. It is a belief that the country will collapse and they will have gold, which will allow them to function economically.
Yep.
But I don't know quite how you buy gasoline and groceries with your gold coins and bars. I mean, basically, you're in a barter situation. So the price of gold, I think, becomes somewhat irrelevant. But that's just my opinion. But when
And
we turn
everybody gets
around,
one.
yeah, everybody gets an opinion, right?
Everybody gets an opinion. Well, we've heard lots of people say, if you're waiting for a total collapse, you're better stockpiling, canned goods, ammo, and alcohol
And
than
cigarettes,
cigarettes. Oh man, a garage full of cigarettes. You're in Fat City. You can trade those
toilet
for
paper.
anything.
Just
The
go back
gold,
to COVID.
gold's not good for much. Warren Buffett said the same thing. If I could buy farmland or gold, I'm buying farmland. You can do a lot of stuff with farmland. All you can do with gold is let it sit in the closet and hope the price goes up. It's not good for anything unless you're a jewelry maker, I suppose. I'm assuming that if we have a total social meltdown, the electronics industry is going to be under some severe pressure. Probably not a lot of production going on, so that gold might not be worth anything in that situation anyway. But you're correct on it. It's a strong personal belief that that's what I need to protect myself, and it does bring a level of security to people's minds, whether it's true or not. I hope we never know, quite frankly.
Not in my lifetime. So
Right.
one of the arguments for gold is you're better off if you own gold than if you own the S&P 500. So this is a pretty common chart from time to time, the S&P 500 price in gold. But in my career, which spans numerous decades, I've never found anybody coming in the office to buy the S&P 500 with their gold coins.
Hasn't happened. And
That hasn't
Don, you don't
happened.
have that. You don't have that chart up, the S&P and
Oh,
gold. You,
let's
you
see.
still have GLD up there, yeah, because that's an interesting chart, and it's one of those things that you can make a narrative, you can build a narrative around. This is important, the S&P 500 priced in gold. Bottom line is, it's not, like you said, Don. We've never had anybody come in and say, "I've got a huge gold position. I want I want to invest that into the S&P 500." It just doesn't happen that way. So it's a side ring in the circus. It's just something else to attract attention. It's a cool chart to put up, and then let's talk about this. But it doesn't really mean anything, not in the real world.
No, and commodities do have an impact on the market and the economy. Well, they have an
Sure.
impact on the economy. When prices of commodities are rising, the industries that are dependent upon them have to pay more, and that is going to cause a rise in price. So we've
Sure.
had, when we take a look at the price of copper, That affects technology. It affects utility companies. It affects telephone companies. You have rare earth metals in your hand computer, your cell phone. So these do
Right.
have an impact on the economy, and people make bets on them. Some of that's a function of supply. Let's see if I can change this, pull up this other chart in a window, and I want that one right there. So this is
There you
the
go.
S&P commodity index versus the S&P 500. Commodities are very volatile, and most of them come with tax issues. So
Correct.
we very rarely invest in commodities in our client accounts because they generate a K-1 tax form. Many of them do, and
Correct.
that tax form is usually not available until after you filed your tax return. If you're an early,
Andy,
well, even if you file on the 15th of April, you're typically going to get K1s all the way up to close to October. It
yep.
takes time to get all the math and the tax law regulation stuff worked out for them to report. So it's problematic. But let me pull up one more chart here. I've got a and it's in my way. I have to get out of here. I think we're going to pass on that chart because it's behind the
That's fine.
light and I can't see where it is to go get it. I
Good,
can
good
get
and
this
true
one.
law. Right.
Yeah, I can get this one. This one is the purchasing power of the dollar, and this has been a problem and an argument for gold. Well,
You,
gold for precious metals. It doesn't
you
matter
don't have
which
that
way
one
you
up,
want to do
man.
it. I'm just getting there.
Oh, you're still working. Gotcha. There we go.
Yeah, yeah. So this is a new setup and a little bit of introductory learning curve here.
It's
Um,
there. Good. Yep.
so this is an argument for gold or some other asset besides financial assets, and that is inflation has eroded the dollar. Of course, a lot of that erosion has been basically fiscal mismanagement by Congress. Let's buy votes. We're past the point of saying Congress has some very specific enumerated duties in the Constitution, and those are the duties we're going to take care of. Defend the country, keep it rolling, but let people live their own lives. Um, Back in the late 50s, well, actually, we go back into the 30s, I think, with FDR and Social Security. There are enough people basically with no source of income and standing in the breadlines. So the government decided that they could fix that. So for widows and orphans, anyway, they created Social Security and the old age. It wasn't called Social Security, old age and survivor insurance, I believe it was OASI, and an orphan benefit. Well, what they learned is that they could buy votes. That was popular, and so Johnson created Medicare. That was popular, except for the insurance companies who
Correct.
yeah, who who were losing the business because they had been selling insurance to seniors to take care of their health issues in their later years, and that business kind of went away, and it continued to erode as Medicare grew, and then we got Obamacare, and we got unemployment insurance. I mean, all these things continue to require more and more money on the government side, and how do they get it if we're not paying
Correct.
enough productivity to generate the tax revenue, and that is they borrow money. And so that's where we end up with this erosion of the value of our dollar. And this chart
And of
is
course, though,
basic.
looking at a chart like this, where it's like, well, what's the point? Why should I be doing anything? The dollar's worth nothing. This chart is only valid if you took all your money, buried it in the backyard, and never did anything with it. And you've got the same dollar you're going to spend today that you made in 1930. And in fact, this is a 100-year chart. You're going to give that to your kids. They're going to spend the same dollars, and their kids are going to spend the same dollars. That's why it's so important to be invested. That's why it's important to get a return that's going to be above inflation because you keep up with this. So while the chart is accurate, it's not necessarily true in the real world because you're going to have invested in if you just invested in T-bills, you'd be ahead of inflation over time periods that long. So it's something that you can do. It's just something you need to take care of. And then when you see a chart like that, don't get depressed and say, well, I should just spend it all today because next month it's going to be worthless anyway. It's not necessarily the case. It just looks that way, and that's the kind of signaling they're looking to send you.
I have some of those relatives. Yeah, you
Right.
probably do
Spend
too.
it today, spend it quickly. Yeah.
I got a paycheck. Let's see. Let's go shopping.
No shortage of those folks are out there. It's true. It's true.
So the resolution is fiscal management at the household
Yeah,
level with your own budget. You can't spend all, well, you can spend it all, but it's not wise to spend it all. To
correct.
set some aside for the rainy day. And for most people, retirement turns into being a rainy day more often than they had counted on. Unexpected events are going to come up, and that's where other resources, whether it was the real estate you bought, the financial assets, the stocks, the certificates of deposits that you save money in, all of which are a part of a well-managed household financial plan.
Correct.
We
And
manage stock portfolios, not anticipating inflation, not anticipating deflation, which does come along. And we've had disinflation
it happens.
from the
Sure.
1980s. So what's the difference? Disinflation is inflation's still a problem, but it's less than it was last year, and it continues to be less and less and less. And that's the way it was from the early 80s until COVID happened. And then monetary policy and fiscal policy changed, and all of it, and very rapidly, we got inflation resurging again, and we're now trying to unwind it. It's not an easy process. If you go into some other countries, we've looked and you learn from lessons. I think of Japan, who has been in a deflationary era since 1989 for a problem which they knew was coming, which was they
Yep.
had a very low birth rate after World War II. If you have a low birth rate, that means you have a period of time, 20 years out, where you're not going to have enough workers. China's dealing with that now, and they are finally, after 40 years, waking up to their major mistake in their one child policy. They don't have enough workers to take care of the seniors. Um, it and it causes social problems. So what do you do with that? Well, one of the ways is you prepare yourself financially. You have to be prepared to take care of yourself. The government entitlement programs are at risk. Nobody wants to say they are, but the only way you keep them going indefinitely is you indefinitely raise taxes, and basically people quit
Correct.
working when taxes reach a certain level. So that wasn't a very
That's a fact.
optimistic way to end the podcast, was it?
No, but we should wrap it up though, Don. We're getting up there. So
Sign up to subscribe to our podcast. The link's right down below. Go to our website, register for the next webinar. We do them on the first Saturday of the month. The shortcut to the website is iriradio.com. That's iriradio.com. But thanks for being with us today. Stay tuned. We'll have more coming in the days ahead.